Trading beginners course, video number 5, selling puts. This is the trickiest of the 4 fundamental positions. I'm repeating myself, guys, but get this into your head. There are 2 products. There are calls and there are puts. You can buy calls, you can sell calls. You can buy puts, you can sell puts. When you buy something, you can expect to pay for it. When you sell something, you can expect to be paid for it. When you buy, you get the right. When you sell, you're obligated to provide liquidity. That's the fundamentals. Get your head around those facts. A put is the right to sell if the price goes down. Puts are concerned with the price going down. Calls are concerned with the price going up. Puts are concerned with the price going down. You can buy a put and you can sell a put, right? In this case, we are talking about selling puts. This is this whole video, selling puts. We receive premiums and we are obligated to provide liquidity to whomever buys that contract from us. If you sell a put, you are selling the right to sell stock if the price goes down, which means you are obligated. And in this case, provide liquidity means you promise to buy the stock from whomever you sell the contract to. Okay, options can be bought and sold at any time. This is worth noting and worth repeating. Most options do not expire. They are sold prior to expiry. 70% of all the options on the market are sold. That position is closed before the option expires. Calls and puts can be traded without ever buying or selling the underlying stock. Also worth repeating, you never have to own Commonwealth Bank shares in order to trade options on Commonwealth Bank shares. Also worth repeating are the core concepts of every single options contract you buy or sell. Straight into the examples. Puts. If we sell a put, if we sell the right to sell something if the price goes down, if we sell a put with a strike price of $25 in early February, okay? Up here, we have sold somebody the right to sell us something. We've sold a contract basically saying, I promise to buy your stock for $25 if the price comes off. This is the worst case scenario for this whole graph. This is ANZ stock. It went as high as $26 and then it tanked down to $22.50. You would not sell a put up here. This is like the dumbest thing we could do. But if we did sell a put, if we sold somebody a promise to buy their stock for $25 per unit if the price comes off, with an expiry in mid-April, okay, it bounces back a little. We're only concerned with the contract at expiry. This person would likely have sold their contract here, all right, but whoever they sell it to, it wasn't us. We've written this contract up here, we've sold it up here, and we're only concerned with the price at expiry. So here, at this point, $23.50, when it expires, our obligation is to buy stock for $25 a piece to or from whomever holds the contract when it expires over here at $23.50. We have to sell this at a $1.50. We have to buy it at a $1.50 markup to what it's worth. Worst case scenario. If we sold a put, if we sold the right to sell something, which means we are obligated to provide liquidity, which means buy it from them. If we sold that contract in mid-May, $23.50. Okay, we've sold somebody the right or the promise to buy their stock at $23.50 if the price comes off. With a week until expiry, the price goes up, puts are concerned with the price coming off, the price has gone up, we don't need to worry. That option expires worthless. Third example, we sell a put in late March, here-ish. Price is kicking around between $22.50 and $23. We sell a put with a strike price of $22.50. That's about on the money, yep. And a September expiry. That's a long-ass expiry. It doesn't, this is fundamentals. This is to get your head around the fundamentals. I don't ever trade strategies that long. You can, I don't. But as far as the fundamentals are concerned, that has a lot of time value. That option would be worth a lot of money to buy or sell because of how long it has until it expires. The price could do anything in that time. There could be another COVID in that time. Fingers crossed, knock on wood, etc. But anything could happen in that time. So it would have a lot of time value and a lot of intrinsic value if the price shifted. So we sell a put in late March, $22.50, September expiry, the price has gone up. Puts are concerned with the price going down. If we sold it, and even if we bought it, it doesn't matter, it's worthless. Last example, if we sold a put at the end of July with a strike price of $22.70, July $22.70, end of July. Well, that's a terrible example because the price is down here. If we sold a put at the end of July with $22.70, we'd be doing extremely well to sell a put with a strike price of $22.70 at this point. The price should be somewhere up here, so this is a bad example. See if you can spot the error in this one. But when that expires in mid-August, we've sold somebody the right to sell us their stock at $22.70, and it expires in mid-August. All right, so the strike price is here. We're concerned with the price coming off below the strike price. It hasn't. It probably couldn't, because in late July the price is up around $25.50, and we've somehow managed to sell somebody the right to sell us their stock for $22.70 if the price comes off below this point. They'd have to be crazy to buy that contract from us, but apparently we have. Bad example. Selling options is inherently more risky than buying options. I cannot stress that enough. In fact, if you get a ComSec options trading account, there will be a test. Okay, and the hardest level of that test is the level 4 test, and it makes it extremely difficult for you to open an account when you can sell naked positions. Okay, selling uncovered calls and puts, it's far more risky than buying it. When would we sell a put? We sell options, puts, or calls to receive premiums. Okay, so that's what we're looking to do when we sell any option, is to receive premiums. A put is concerned with the price going down. We would sell it if we thought the price was going up, or even if it was going to stay the same.